Hello, and welcome to the Weekly Watch podcast series. I'm John Briggs, Global Head of Desk Strategy. This series helps you cut through the noise of global financial markets with a quick take on the upcoming trends to watch.
Hello, everyone. This is the first podcast recorded since the significant miss in the U.S. jobs report. And since then, we also saw a large miss in the U.S. Consumer Price Index. While the jobs number was weaker than expected, the inflation data was stronger than expected, and the result's been a wild ride for the financial markets in between. First, jobs miss caused a fall in bond yields, albeit a passing one, as well as a weaker dollar, better risk assets, as the markets took the number to mean that the potential for the Federal Reserve to talk taper or to move up any sort of timing for reducing accommodation was delayed, and that policy would stay easier for longer. But just a few days later, the stronger inflation print, on the other hand, brought the reverse. Worries that inflation coming stronger than expected may bring the Fed to taper and eventually tighten policy sooner than expected. This caused a stronger dollar, a rise in bond yields, and has since weighed on risk assets, especially U.S. equities. So on the subject of the data, I'm joined today by our chief U.S. economist, Kevin Cummins. Kevin, what are we going to make of this data? Is the market overreading these prints? Do we think the job market is really slowing to the extent that we saw? Is inflation rising as much as we feared? I mean, these are pretty big moves here, at least versus consensus. So what are your thoughts on all this?
Yeah, I mean, from the perspective of, relative to expectations, both of these reports, no one saw coming, as you pointed out. From the perspective of the labor market, I think taking a step back, and I think it's worth, thinking it in a little bit broader of a picture than, the last couple of reports. I think fundamentally the recovery is still on track. We're very well underway. We saw a very strong Q1 GDP report, and most of the other data suggests that things are picking up into Q2 with regard to the growth side. The deceleration in payrolls, it probably was underappreciated heading into the report, that there are some constraints on the supply of labor. And I think that's what really weighed down payroll growth, rather than evidence that there's weaker demand for labor and things are fading. So, in any given month, I think payrolls are everybody knows, is a pretty obviously volatile number, and you could be off several 100,000 in a typical month, not necessarily a million, but given the pandemic, these numbers are very difficult to forecast. So, it's a big miss relative to expectations, but 266,000 jobs is still moving in the right direction. It's just that, the demand side of the economy is very strong. We obviously had a lot of fiscal stimulus and reopening the economy. Things are really starting to take off, in my opinion. But the supply side is, while it is starting to recover, it is struggling at least to meet some of that demand. There's obviously COVID disruptions, supply chain disruptions, part shortages, semiconductor shortages, and so on. So I think, all those factors probably went in the same or the wrong direction relative to payrolls. So I think that's probably why we saw. I mean, this morning we saw some more very good news on jobless claims with another pandemic low of 473,000. If you look at the 4-week moving average there, you're fallen in 13 of the last 14 weeks. So I think, in the broader context of a pandemic, that's very good news. So, I'm still pretty optimistic on the outlook. I think that growth is really going to move into the summer with some upward momentum. I think Q2 GDP is certainly going to be stronger than Q1. Earlier this week, we saw JOLTS data that did show job openings reached a record high of 8.1 million openings. With that sort of rising vacancy rate and kind of the sluggish rebound that we're seeing in employment, that certainly points to labor market constraints here facing the economy, at this time as we head into the spring. If you listened earlier this week, the NFIB survey did show that that finding qualified employees is their biggest challenges for small businesses, and that is potentially going to hit growth a little bit from that perspective. I think it was 44% of respondents said that job openings couldn't be filled because of the difficulty of finding qualified employees. So, we are seeing these supply issues, which probably aren't necessarily going to fade away anytime soon. There's obviously very generous unemployment benefits that go through September. So I think this is probably going to hold back perhaps the pace of job growth as we move forward. But I still am pretty optimistic on the overall labor market in general and the growth side. The inflation data, again, that was one that no one saw coming either. The increase in core clearly is reflecting these transitory, at least from the Fed's perspective, these transitory factors. Now, the magnitude obviously was much greater than I think, but even shortly after the report, Clarida very much dismissed the worry or the concern perhaps by Fed officials. So I think if we were to see this persist throughout the summer months, then I think the Fed would potentially change their game plan. But I think right now, while the magnitude is bigger than people expected, these supply chain related events that are all kind of coming together at the same time seem to probably have temporary push core prices. We aggregate within the inflation data how much of it was related to COVID, in the wake of COVID. So you looked at things like hotels, airfares, a lot of the used car supply issues that are going on there. And we're starting to see, some inflationary movements pretty high. In fact, used car prices were up 10% on the month. That's, a record gain. And about 70% of the increase in the core was directly related to COVID. So I think right now, yes, it's very, it was a very big headline, but I don't think the Fed, at least from their perspective of interest rates, has to rethink their view that things are going to moderate later this year. But it certainly amps up the debate whether or not the pickup that we're starting to see is transitory and not. And I think that debate is probably likely here for a while.
Yeah, well, it's good to hear because for my view, or at least that some of this is transitory. My view is, me, I'm not really much of an inflation guy, but that this conversation, we were always in the September taper time frame when the Fed would start to talk about it, we started to see a lot of that move up towards June. People were talking about if we get 1 million jobs or 2 million jobs, that maybe the Fed's going to. It certainly really pushed that off on the jobs report, but then the inflation number came and it started being, oh no, man, now the Fed's gonna have to taper and all this stuff. So, for me, I think that hearing you reassure that it doesn't, the Fed's gonna look through some of this stuff, we need a few months, I think is going to be a stabilizing factor, for risk assets. And for me, being a more positive on the outlook on the growth side, looking at all these other growth numbers, coming out. And unfortunately, we're recording right before retail sales number this Friday, but I think that's going to go a long way just to reinforcing, hopefully, that, the growth outlook is good. And this is a labor supply issue, not a labor demand issue. But, on the inflation side, one problem, I think, maybe not problem, but one issue is for the next few weeks, until you get that next report, I think the fears of inflation could linger. So I think that for the next few weeks, we're definitely going to have choppy markets. We thought this would be a period as we head in towards taper season that you start to see more volatility. And I think that this data, just, the misses, the size of the misses certainly, makes that volatility likely to continue. So I think in the end, over the next, if you're looking month to month, things are still going to be okay, but we could be in for a bit of a wild ride, at least until we get to the next payroll report, the next CPI report, just to see if these trends are verified. So could be an interesting few weeks. On that note, Kevin, thanks for joining us. Appreciate the insights, and see how this all comes out of the wash.
I hope you have enjoyed this episode of the Weekly Watch. Please subscribe to our channel to get future episodes. We also encourage you to explore more of our content on our website and other social media channels.